All right. Good morning, good afternoon, good evening, everyone, and welcome to the Thursday edition of the Daily Stack. Today, it's the macro edition. We are hopping in with Robert, we have Infra, we have Adam. We are chatting through everything and anything Bitcoin related. And wow, what a day to go live. Bitcoin is what seems to be capitulating in the grand scheme of things. We're hoping this is a quick flash bounce, a drop, and a correction back up. But everyone else and their mom is discussing the bear market vibes that we're about to be entering. So let's jump straight into it. If you are tuning in on Rumble, on YouTube, on Twitter, drop in the comments, say hi, join our community, retweet the stream, give us some exposure and some love. We would muchly appreciate it. With that being said, let's begin with topic number one. On the right-hand side, we have everything from silver to gold to CBDs, but one of the top topics at the moment is good old Kevin Warsh, who was just elected in Infra. What are we hopping into?
Yeah, so a lot of folks seem to be quite worried about Kevin Warsh. I mean, we've seen silver and gold down significantly since since that announcement that it would be Kevin Warsh. I think the market was positioned probably much more for someone like Kevin Hassett than someone like Kevin Warsh. Who is generally seen as more hawkish. I would say significantly more hawkish than someone like Kevin Hassett, who would have just been a tool if the administration did whatever Trump wanted. And so with Kevin Warsh, he's made statements. Obviously, he has a history at the Fed, and he's made several statements since then, after he left, that were definitely much more on the kind of Fed critic, much more hawkish sort of vibe to it. For example, one comment that a lot of people talking about, he's mentioned the balance sheet, that he would like the Fed balance sheet to be much closer to 3.5 trillion than to where it is currently at about 6.6 trillion. But he's also obviously, when it comes to interest rates, in the past, he's expressed a much more hawkish view when it comes to the overnight interest rate that the Fed controls. I think just personally that it's kind of overdone and that he will not be able to be nearly as hawkish as people are apparently quite concerned about. Here we're looking at the Fed balance sheet. And obviously, a lot of folks probably in the Bitcoin world are familiar with the Fed balance sheet. This is the value of the assets that the Federal Reserve holds. But what a lot of folks don't probably know is that every dollar of assets on the balance sheet on the asset side must be offset by a liability. So technically, Fed assets are equal to liabilities plus capital. Capital is such a small component that it's not even shown here. But a liability would have to go down. If Kevin Warsh was really going to try to reduce the balance sheet from 6.6 trillion, you would have to reduce an offsetting liability as well. And I don't know where that can come from. So bank reserves right now stand at about 2.9 trillion. That is half of the monetary base. Bank reserves plus currency, which is shown here in orange. Currency, as you can tell, grows very, very steadily. No real drama when it comes to currency in circulation right now, about 2.4 trillion. Bank reserves are much more volatile. Those are the kind of base layer of money for the modern kind of fiat US system. And that is what the Fed controls. That is what the Fed prints when they engage in quantitative easing, for example. They are printing bank reserves and then using those bank reserves to buy an asset. So the bank reserves go up as the Fed prints those out of thin air. They get transferred to a bank because the Fed is buying an asset from a commercial bank. So the Fed gets an asset from the bank, and the bank gets freshly printed dollars. That is, when the Fed is engaged in quantitative easing and that sort of thing, that's what we're talking about is bank reserves. Well, that, kind of many folks would probably look at the liabilities and say, well, reduce that. You could take that down to 1 trillion or 1.9 trillion. Well, the problem here is that we've already run into issues when it comes to bank reserves. So Q2, Q3, Q4 of last year, we had issues in the repo market. when bank reserves were declining quite precipitously. Here you can kind of see that little decline here. This was when the repo market really kind of got stressed, and we saw spreads start to widen. We saw SOFR start to increase. It was outside of kind of normal liquidity windows, right? Like end of quarter window dressing or tax deadline or those sort of things. We were even seeing kind of SOFR spreads starting to widen outside of those normal time periods. So there is definitely issues in the repo market. And the problem there is that the basis trade, which is a highly levered 50 to 1, 100 to 1 levered trade, that is financed in the repo market. Well, why does that matter? The basis trade is responsible for about 40%, about half of all U.S. Treasury issuance that has been purchased going back to 2022. About half of it has been financed in the repo market via this basis trade. So you can't let SOFR spreads widen. You can't let the repo market start to dysfunction, because then you remove basically the entity responsible for buying almost half of the debt, the new debt that is being issued. So they can't meaningfully reduce bank reserves, because it would cause issues there. The reverse repo is empty, basically. It's at 1 billion, so nothing to reduce there. TGA, Treasury General Account, this is the government's checking account, right now about $1 trillion. You could theoretically reduce this. The problem is that, just like normal people like to have a buffer in their checking account, the Fed does too. Or excuse me, the Treasury does too. So you can't reduce the TGA because we're rolling so many T-bills every 5 days. There's about $600 billion worth of T-bill redemptions. And so we can't meaningfully reduce the TGA, which means if you can't meaningfully reduce the liabilities here, how are you going to reduce the assets?
So with that all being said, I guess the real question is here, in terms of tying this back to Bitcoin, is this all just political posturing in terms of how he words certain things? And then secondly, on top of that, if I'm a Bitcoiner looking at this and I've been told that the narrative is Fed prints more, number go up. First of all, is that accurate? Because it looks like there's 5 or 6 different components of the Fed balance sheet here, and it's not a simple yes or no answer. B, if it is that simple, are we just looking at bank reserves as the yellow line before potentially reinserting that liquidity back into the system for a potential recovery in, say, Q3 of Q4 this year, if the bear market is in?
Yeah. So, yeah, a number of things. So bank reserves, there is kind of a growing consensus within the monetary policy community and macro, serious macro folks, that bank reserves should grow in line with GDP. This has been kind of an emergent school of thought theory for the past year or so. And so, if GDP is growing at 3%, well, bank reserve should grow at 3% per year. So I think what is probably much more likely than a dramatic decrease in bank reserves and therefore, reduction in the balance sheet, some return to aggressive QT or something like that, is probably that the balance sheet stabilizes here. And if anything, probably, trends higher. I don't think that he's going to be nearly as hawkish as a lot of folks seem to be worried about. And as bank reserves go up, I've posted charts before, but this is generally correlated. Like when you see a bottom in bank reserves, generally that is the bottom in Bitcoin too, and it starts to head higher. So this is all also kind of like, outside of putting aside the potential issue of a recession or a growth scare, in which case the balance sheet is going to go up. It'll be no different from any other deflationary shock. They will print a lot of money that'll create or cause the bank reserves. They'll print a lot of money. Bank reserves will go up, probably set a new high, and the balance sheet will go up, corresponding with that. So if you are in the, oh my God, the JOLTS data is really bad and the initial claim are spiking and challenger layoffs are spiking, and we're about to go into a recession, maybe you do get an initial move sharply lower with Bitcoin. but the liquidity always comes. So it all becomes, what is your time horizon?
Yep.
Personally, my time horizon when it comes to what I do with, with regard to Bitcoin is 10, 20, 30 years. So I don't really mind the volatility. I'll I try to buy it because again, my time horizon is so long. But if I was levered, some of these people that trade, perps and stuff, I would probably be a little concerned.
Gotcha. Yeah, I know that makes total sense. Adam, I want to bring you in here. Are you looking at jolts, at jobs numbers, at any of these kind of macro conditions, and is that affecting kind of your overall view on Bitcoin, or are you more, hey, I'm a developer, I'm looking at this as a 10-year plus asset, and these kind of Bitcoin bull or bear markets over the next 12 months are really don't surprise you in the slightest?
Yeah, I'm a little bit one foot in each camp. I'm certainly not a professional trader by any means, in the same sense that most people might refer to that being. Most of my trading is done trading fiat for Bitcoin and then trading Bitcoin for goods and services that improve my life. However, I do a fair bit of trading kind of on the side for fun, and investing, macro type stuff a little bit. It's not, like I said, it's not what I've spent most of my life doing, but I do have a little bit of fun, kind of just looking at different charts and making some money when I see opportunities. I recently just exited a short silver position that I started around a little over $100 mark, which was fun for me. But I got out of it mostly because of a lot of the uncertainty that I'm seeing with a lot of these indicators. And I think there's just so much going on right now in the macro space that my personal position right now is kind of staying out of most of these markets, just because we're kind of going through unpredictable times right now. And if I was as smart as Robert, I would probably, be in a different position, but I'm working on about half the IQ as he has. So I'm more of a buy and hold kind of guy on sats. But going back to the topic, I saw one of the comments that just got popped up here. Somebody said something about Trump ruining Bitcoin or something like that. I think that's, kind of funny. I wanted to share something real quick. It's not funny, but it's ironic that I just read from man, I'm going to have some trouble sharing my screen. I'm sorry. I didn't have this set up. Oh, here we go. All right. So Magoo, he says, are you guys seeing my screen? Yeah, there we go.
It's on the main screen.
I legitimately think Bitcoin price would be higher right now if Kamala Harris won the election. I couldn't help but to laugh at that. I think that there might actually be some truth to that. I don't know if we'd be in a better place necessarily, all around. Who knows? But I do want to bring up the political factor because it does play a big part into the short and near term price action of Bitcoin and Bitcoin adjacent investments, and really the market as a whole. And I want to say, like, I think, speaking from the Trump administration, from what I've seen, is a lot of the opposite of what I had expected initially. I think for the first 6 months, we were on a good track, speaking from a Bitcoin perspective. And I think from starting maybe June or so of last year, things have, I think, deteriorated on his Bitcoin position. Not to say that I know what he's doing or thinking, but I haven't seen any really good actionable policies come out of the Trump administration, aside from promoting and undergirding the foundation of what I think is going to be the foundation of what I would consider the CBDC that we're kind of trying to roll into. I think that is coming to the United States. I think it's kind of in a way already here through the guise of stablecoins. Maybe we can get into that more later if you guys want, but I just want to kind of bring that up because that's kind of the way that I'm looking at this. And as I'm looking at things like Kevin Warsh, for example, this is a guy who's been vocally pro CBDC. he has said, he's on the record saying that he wants a CBDC in the United States to compete with China's. And I think this is why I'm scared of Kevin Warsh. It's not necessarily because of his monetary or fiscal policy, but his overall view and perspective on money in general does worry me a little bit, because he's got this CBDC mindset. He's a central planner, and I am personally, not. So it's just I don't think it's necessarily a threat to Bitcoin, especially in the long term. But it does worry me from the perspective of being a U.S. citizen and potentially being subjected to somebody who has a ton of power that has, an intention of fostering and growing a CBDC in the U.S. So, yeah, I just wanted to mention that. That's where I stand. I don't know if you guys have any thoughts on those.
So I think what would be interesting is maybe to get Infra's take on the CBDC itself, and how that would filter into how money gets distributed through the economy, because that's really what it comes down to, is control that CBDC is providing to the central authority whose blockchain it's issued on. And if that's going to govern how money is distributed, Infra, I'm curious on your end as to how that might affect the fiscal deficits, the trade deficit, how money is really controlled through interest rate policy at the moment, and through other policies as well.
Yeah, I mean, CBDCs open up a lot of possibilities. You could program money so that it expires, right? And like you have to spend it. For example, like there are basically endless possibilities with a full blown CBDC that would be pretty difficult to for the way I look at things to model out. I would say that there's probably a difference between a CBDC when it comes to the M0, which is the bank reserves and currency, right? The base money. Having a CBDC in M0 is probably a lot different than having a CBDC for the M2, which is the broad money. That's your checking account, money market fund, that sort of thing. So I think that there's probably a huge difference when it comes to things, for example, like the velocity of money, which is a critical component when it comes to measuring economic activity and output and inflation and that sort of thing. M2 velocity, which by the way has been plummeting going back to 2001. That was the peak in the velocity of M2, which is again the kind of the broad money. And airdropping money to, look, in a world, I don't have the right brain for modeling this stuff out, but in a world, say 20, 30 years from now, where AI has caused 30% unemployment rate, and there's UBI, well, that UBI, if it was done by a CBDC, number one, you could program it in various different ways, but that kind of money has way higher velocity. So we know the lower income cohorts have a much higher what's known as propensity to consume than the more wealthy cohorts. They save much more of their money, and so when you're airdropping, I don't know, $2,000 to every single household below a certain threshold, that money's going to have very, very high velocity. They've done stuff. I can't remember the exact figure off the top of my head, but there's a paper I read that looked at the velocity of money for the COVID stimmy checks. It was quite high. I want to say that it was above 80 cents out of every dollar got spent. So yeah, there's definitely implications. And I would say there's a pretty large distinction between, are we talking about a CBDC on the reserve or the base money level, or are we talking about a CBDC for the broad money, which is kind of a much more scary sort of prospect. Everything that I've seen out of like the Fed and kind of the think tanks that feed into what the Fed is going to think have more oriented to the base, a CBDC for the base layer of money, the M0, if anything, right? So, it's it would depend a lot on, are we talking M0, M2 when it comes to, which layer we're targeting, how programmable, what program is put on it. If you're not allowed to save it, and it expires, well, that could be very inflationary. I think that, again, the marginal propensity to consume of kind of lower and middle income cohorts is so high that, you start talking about a UBI sort of thing that is done via CBDC. That money is going to have very high velocity to it. So yeah, a lot of potentials.
And just to clarify, sorry, Adam, before you hop back in, the primary goal behind the velocity of money increasing is in order to promote spending and GDP so we can grow our way out of this debt? Or what is the kind of the underlying, besides, obviously controlling the money supply, which is the goal of all centralized authorities somewhere?
Yeah, if you can get the real economy to start, if you can increase the velocity of money, and look, it's very inflationary. It's not without its trade off or side effect. But yeah, if you can increase the velocity of money, that's theoretically good for kind of the real economy, which I've been arguing, for the past 25 years, the real economy has been kind of decaying in favor of this kind of hyper financialized casino economy thing that we have now. So a return to, if they're really serious about reindustrialization and balancing trade, which would, by the way, end the dollar's reserve currency status. If they're really serious about, kind of restructuring the U.S. economy and trying to rebuild, the real economy, how you do that in a world of increasing AI and robotics, I'm not sure. I think we should try, but I think that sort of thing could be difficult in the world of AI and robotics. But look, the other side to it too, that loops into Kevin Warsh is, people talking about him hiking rates, I think, are way off base. Like, fiscal dominance did not just magically disappear. We're still spending 23% of every dollar in tax revenue on interest. Interest is still growing at 15%, if not arguably even higher. The interest rate, or the interest expense, that interest outlay, 1.2 trillion per year, that is only going to grow, because right now the average interest rate on all of our marketable debt is about 3.3%. Well, the lowest point on the yield curve currently right now is the 1-year US Treasury yield. That is at 3.4. So even if we issued and refied all of our debt in the 1 year, our interest expense is still going to grow. So they have to get the overnight interest rate lower. They have to make the dollar cheaper, right? Because when we're talking about the Fed and the interest rate policy, what we're really talking about is the price of a dollar, the price of money, which is the interest rate associated with it. So they need to make the dollar cheaper by lowering that interest rate, the overnight interest rate, which will therefore lower the T-bill yields. And we know we're issuing and rolling a lot of our debt there. So that is one way to address the burgeoning deficit, and that is still 6% of GDP. The best way to address it, not cut Social Security and Medicare, that's never going to happen politically. You go after the interest. Right now, interest is a huge component. It's the fastest growing component. Just run negative real rates, right? Cut the Fed funds, make money cheaper, make the dollar cheaper, cut that overnight interest rate. You get a steeper yield curve. Steeper yield curve is good for private credit creation for the banks, right? It's good for financials because they borrow short, lend long. So they're incentivized to borrow short, lend long. And, you get a kind of reflexive loop. Now, again, there's a trade-off, which is, higher inflation and, kind of higher activity if it's not offset by huge productivity gains. But yeah, you lower the Fed funds, you create a steeper yield curve that incentivizes the private banks to come in and, more money printing from the private banks, which kind of feeds on, boosting economic output for the real economy.
Yeah, I want to bring something up related to that, because I agree. They want to, make the dollar cheaper. They want to lower the cost of the dollar. One thing that I noticed, and I haven't checked this number recently, but I saw a headline. Maybe Robert, you could correct me, or at least update me on this. But I saw that the average rate, the average yield for treasuries was higher maybe a month or so ago than it was when they started cutting rates at the Fed.
Yes, that's correct. Longer term rates, and we've never seen this before, really. At least the data I've looked at, going back to the 50s, 60s, we've never seen the Fed start a rate cut cycle and the 30-year U.S. Treasury yield go up. So when the Fed started to cut, the 30-year U.S. Treasury was at 3.97. It is now at 4.88. So it has gone up by about 100 basis points in the wrong direction. Normally, when the Fed starts to cut, rates come down, whether it be the long end rates or the short end rates, but the short end rates fall the fastest. That is what's known as a bull steepener. It's bullish for bonds. And that's generally what you see in a rate cutting cycle. That is not what we've seen. We've seen the 10-year Treasury yield go up, 30-year Treasury yield go up, 20-year, 5-year, 7-year, 3-year. The vast majority of the curve has gone up since the Fed started to cut.
So what that says to a layman like me is that their strategy isn't working, and they've got to find a way to get more appeal to just the bond market in general. That's kind of what I'm seeing. Well, on topic, you were talking about broad money and base money for CBDCs, and I want to share something real quick. So I am making the argument that stable coins in general, and maybe even more specifically Tether, is a de facto broad money CBDC. And don't take my word for it. Take the CEO of Tether's word, Paolo Ordoino. Let me share my screen with you. He says himself, we will become the gold central bank in a post-dollar world. And the reason why I bring this up is because the common argument against this case was that Tether is not centralized. They're not a centralized bank. The CEO himself is literally telling us that they will become a gold central bank, using those exact words. So I'm just going to use his words, not mine, to make this case. But my point is, I think it is my belief that it is, maybe we haven't crossed whatever threshold meets your particular definition of what a CBDC is. But for me, I think Tether already is a CBDC. It's already programmable. It's already controlled by the United States government. We've seen billions and billions of dollars worth of Tether frozen at the direction of the Department of Justice, and they can effectively control, everybody's money that's using this platform. Now, obviously, that is a little bit of an exaggeration, but to some degree, they are able to programmatically control the people that are using this currency. The U.S. government is, which is, of course, the argument is no, Tether is a central, a private issuer, and they're not a central bank. Well, here we have the CEO rejecting that premise. So my point is, I think Tether is effectively a de facto CBDC for broad money, and I think it's already here. And the only question is how long until we legitimize it.
Yeah, ultimately, I want to disagree that like all the building blocks are there kind of already, right, with Tether. Because
they also own a ton of gold, right? So Tether you say that they're not a central bank, but in de facto they are. They're sitting on $24 billion worth of gold, in addition to the fact that they obviously have the stablecoin itself and can programmably decide how they want to move that money around on behalf of their quote unquote end users, which is the bulk of the market today.
Yeah, and one of the other points is, it's a very convenient opportunity for the Treasury, or for the U.S. to offload treasuries, and increase demand for treasuries. Like we were saying earlier, they want to find a way to bring the rates down, and in order to do that, you have to increase the demand. Well, this is one really great way. In fact, Tether is one of the largest purchasers of treasuries in the world. And so, they're effectively helping to bring the rates down. It's not working at the Fed, like we already discussed. They're trying to lower rates. I think they're in a bad spot because you mentioned earlier, Robert, like we need to lower rates. We need to, like, rates have to come down. The market rates have to come down. The public rates have to come down. But if the Fed rates, Fed rate control isn't working, if we can't lower rates and it's not reflected in the overall market, then there's a huge problem there.
Yeah, there is always demand for U.S. Treasuries at the short end. Like we regularly have auctions of a T-bill 3-month or a 6-month bill or auction that are like $100 billion in a single auction, and the bid to cover will be like 3.5, where the normal bid to cover on a 10-year is 2.5. There is demand for sure at the short end. There's a side effect to this, which is that financing your government in the cash market, basically, is very emerging market like. It's very inflationary. T-bills are much more money like, because a treasury is just an interest bearing dollar with an expiration date. A T-bill is much more cash like. It's much more akin to printing money, and those T-bills are much less volatile than a 30-year, for example, meaning they can be more readily levered. The haircut that you might take on it to lever it up is much lower because they basically don't move in price. And so, it's much more inflationary. It's much more stimulatory, but that's where the demand is right now, is in T-bills. They can do it. A lot of people, hear this and they go, well, that's cheating, or they can't do that. It's like, no, they absolutely can do that. The problem is you remove the Fed's ability to be independent, because if you're rolling your debt every 1 month or 3 months, if you're the Fed, you can't hike interest rates. Inflation could go to 6% at the next CPI print, and you want to be able to hike interest rates, because if you hike interest rates, well, within a month to 6 months, all of your debt is going to be, because T-bill rates just follow the Fed, all of your debt is going to be refied at a much higher rate. That's going to blow out interest expense, therefore blow out the deficit, therefore blow out bond supply, and you can get into a reflexive kind of debt doom loop. So there are consequences, which is you remove the Fed's independence or ability to actually set, independent monetary policy with respect to the interest rate. But you also, it's kind of more stimulatory. It's more run out hot. It's more inflationary, whatever you want to call it. But they can absolutely do that. That is where the demand is. I would just make the caveat that, in a world where, say, the Fed funds is 1% and inflation is 3.5 or 4, you're talking about a negative real yield. What that means is if you buy T-bills and hold it for 1 year period of time, you are guaranteed to lose money. Now, if you're in Turkey or Lebanon or, Argentina, Venezuela, someplace like that, you're going to be happy to take the stable coins, no problem. But, outside of that, I kind of question how much demand. I don't think that we're going to see, $1 trillion, $2 trillion, $3 trillion of new demand for T-bills. I think that some money will shift from one pocket to another, right? Take $100 out of your right pocket, put it in the left pocket, but that's not new demand. Actually a net increase in new demand. Remember, just kind of for comparison, JP Morgan said, I think 350 billion of new T-bill demand. We roll every 5 days, 650 billion every 5 days in T-bills. So what JP Morgan is projecting in terms of an increase, the net increase in demand for T-bills, is like 2 days worth of redemptions when it comes to T-bills. So it'll increase. I just kind of question how much it'll increase when it comes to T-bills.
I've got a tangential question, especially for you, Robert, real quick. Do you think that what we're seeing right now, do you think yield curve control is on the table? And if so, what would need to happen, and how far out do you think that would be?
It's definitely on the table. I don't think it's super close. I don't think it's a kind of an inevitability, at the present moment. We haven't really seen the long end blowout. And, you compare the US 30-year yield to, say, Germany, France, UK, Japan, their long end is much more unruly than ours. Now we are kind of, right up there around, 4.95%. And, maybe in the right sort of situation, if we start to upset the rest of the world, you could get a dislocation. You could get rates move sharply higher, just like we saw on Liberation Day, which is foreigners sold U.S. stocks, they sold the dollar, and they sold U.S. treasuries. And we saw the 10-year U.S. treasury yield go up by like 80 basis points in 3 days because, with a net international investment position as negative as ours is, we have effectively lost sovereignty. We can't do anything, unfortunately, with a NIP of negative 95% GDP that upsets the rest of the world, because the rest of the world owns us. So you could see a situation, I guess where I'm going with this, you could see a situation where Trump, ratchets up the tension against the rest of the world, maybe new tariff threats, or, some kind of aggravation towards the rest of the world, where they go, okay, we're done with this, dump, 20 billion in US treasuries, and then dump the dollar. You could see a situation where the 30-year spikes, again, akin to the way it did in early April. Then you might see, a QE, a more aggressive QE. I mean, we shouldn't forget that we already started I mean, it's not called QE, but it's effectively QE, which is, the Fed is printing bank reserves again, and they are using those bank reserves to buy T-bills. Because there were so many, the degree of dislocation in the repo market was such that it was concerning to them. And so they had to start buying T-bills to make sure short end rates didn't get too out of control, blow up the repo market, which would blow up the basis rate, which would blow up, a huge amount of US Treasury, net increase. So, I think, it's definitely possible, given kind of the right sequence of events. We are definitely not in a super strong position. We kind of have to thread a needle where we don't make the rest of the world super upset, because if we do, they own us. Literally, they own our equities, they own our US treasuries, they own our corporate bonds, they own our real estate, our net international investment position, that foreigners own about $65 trillion on a gross basis of US dollar denominated assets. We own much less than that. The NIP is the difference between what we own of theirs and what they own of us. So yeah, they could start dumping, and that could cause long end rates to shoot higher. That could cause them to kind of come in and say, okay, instead of 50 billion of these T-bill purchases every month, we're going to do 70 billion, and 50 billion is T-bill still, and the extra 20 billion is going to go at the long end. That's probably how it progresses, over time, because the real world is priced off the 10-year, not off the Fed funds. Mortgages, car loans, small business loans, all that kind of stuff priced off the 10-year. And the 10-year has gone up since the Fed started to cut, from about 3.6 up to about 4.2. It's gone up. And again, this never really has happened before in a cutting cycle. So, I think that it's definitely a possibility. I don't think it's kind of like super inevitable, like, it's a guarantee. I don't think we're that close, but I do think that it's definitely a possibility.
So I guess on that, sorry, Adam, I do want to bring this back into your wheelhouse as well, because we got a question from Maddie Nelson, which I think ties into this. Where is your head at with the 10-year over the next 5 years? And I mean, specifically, if you're a millennial looking to buy a home, where does that 10-year go, in your opinion? Gun to your head.
In my opinion?
Yeah.
Well, the 10-year, so when it comes to buying a home, the mortgage rate there is priced off the 10-year, but there's a spread between the mortgage rate and the 10-year treasury yield. That spread was quite wide back in, say, 2022, 2023. It's been declining. But that spread, I think, is really what they're going to try to target. And if you listen to people like Rick Reeder, who's chief investment officer of BlackRock, obviously pretty in the know guy when it comes to markets and plumbing and all these kind of things. He did an interview with Bloomberg where he talked about the best way to get lower mortgage rates is to decrease bond market volatility. And this is because bond market volatility and that mortgage spread that I was talking about are basically the same chart. So I'll try to pull it up here real quick. But the MOVE index is basically the VIX for the bond market. And that is essentially the same thing as the mortgage rate minus the 10-year treasury. So the degree to which the mortgage rate is above the 10-year treasury, they're basically the same line. So if you can decrease bond market volatility through the MOVE index, you can decrease this spread and get effectively a lower mortgage rate. So that's probably what they try to target. if I had to guess, they probably try to go after the spread and try to compress that spread a little bit. They might QE a little bit as well. You know, he mentioned that with the reduction in issuance at the long end, that we kind of get more bang for our buck than we, you know, because there's so little supply at the long end. You kind of get more bang for your buck with QE and that sort of thing, because there's so little of the duration actually out there, that, you know, $1 of QE for the long end will get you a bigger impact. And this is all stuff that Rick Reeder was saying, well, you know, in his interview with Bloomberg. So for some reason, I'm not able to pull up the right mortgage rate, but the long-term data shows that. I mean, I would encourage people to look at this. It's basically the same chart. So I think that that'll be, you know, that's what Rick Reeder suggested, is to try to decrease bond market volatility. That'll compress the spread, and you'll get, even if the 10-year goes nowhere, you'll get a lower mortgage rate. And that's what's been happening for the past, I don't know, 2 years, 3 years.
Gotcha. So we're bullish on the US 10-year?
No, definitely not. You couldn't pay me to buy the 10-year here. Well, you could, but a much higher interest rate. But like trying to short it is not. I don't have a clear, like, there's so much potential for not manipulation, but manipulation. You know, I think trying to trade things like the 10-year in an environment like we're in is probably pointless. So yeah, I look, I think that they will try to get lower mortgage rates because, you know, Trump and every populist leader realizes that, you know, this is what you have to do. Populism is all about, you know, delivering promises to the disadvantaged folks right now. That's young people. And, you know, that we are becoming a larger and larger cohort in the voting population, and politicians are more and more, I'm realizing, even here in California, Tom Steyer is running for governor, and he's gone full-blown populist, talking about banning corporate purchases of single-family homes, lower zoning fees, and regulations on the zoning side. You know, they're all going populist because young people are becoming a larger and larger share of the voting population. We're more and more disenfranchised. So, you know, there's going to be continued efforts to get lower mortgage rates to try to stimulate demand and kind of improve affordability.
Yeah. Well, let's hope that they do move down, because if I'm looking to buy a home anytime soon, would certainly help. I did want to transition over to ISM, because I came across this tweet the other day from our good friend Sminson, who's a friend of the stream, and I've seen this doing the rounds recently in terms of a potential significant uptick in the ISM. I know there are a lot of macro pundits out there who are tracking ISM and the business cycle, specifically, you know, like the Raoul Pals of Twitter, Bitcoin Twitter, and using it as potentially a lead lag indicator for future liquidity, future price pumps. I'm not necessarily bullish on Bitcoin reversing tomorrow, but if there ever was a narrative that would justify that price action, I believe this would certainly be it. And I guess I want to challenge both you and Adam on this, because it's something that's interesting and definitely worth keeping an eye on.
Yeah, I've been listening to Raoul Paul for a while now. I think going back to like 2020, maybe back in the Real Vision days, I want to say. And he was the first one that I heard, at least, to talk about ISM in regard to Bitcoin. And I've been watching it ever since. I think that there's, you know, here, for example, is ISM manufacturing, and 50 is kind of the baseline. When it comes to ISM PMIs, Purchasing Manager Index, it's soft data, right? It's survey data. 50 is the baseline. So anything above 50 is expansionary territory. Anything below 50 is contraction. And generally, when the ISM manufacturing crosses back above 50, right, back into expansion territory, generally that's coincided with huge bull runs in Bitcoin. And so here I've marked a couple crosses where, you know, we went from contraction territory into expansion territory, and generally Bitcoin has benefited from that. We just got a huge pop in the ISM manufacturing PMIs. And there's also a GDP component to it as well. So here, for example, we'll look at employment PMIs, GDP offset by 2 months. So, or excuse me, 3 months. So GDP is pushed backward by 3 months, and you have, the ISM PMIs. There's a pretty tight correlation to this. So, what the ISM PMIs are showing can generally be a good forecast of like what GDP might be. So I think that PMIs are very useful. I've been showing them in my videos for a while now. The ability, we've seen a bit of a kind of divergence, I guess. But whether you look at ISM manufacturing PMIs or whether you look at the services side, which is obviously like way larger share of the US economy is services, not manufacturing, all of them have been pretty weak. So here is, for example, manufacturing. I'll take the GDP offset, but we can see that like employment, for example, which is the green line here, this has been in contractionary territory, arguably going back to like mid 2022, early 2022. If you look at new orders, it's kind of the same story. Going back to like early 2022, dipped into contraction, and we've flirted with these kind of breakouts into expansion territory. But generally, like we've been, if you were to pull a moving average or something, we've generally been below 50. Now, this is manufacturing. Here's the services side, which has been, stronger. Still not great, but definitely stronger on the services side, which, also has a correlation to inflation. I use ISM prices a lot with my inflation videos because it's a fairly good barometer of where CPI is going to be in about 2 or 3 months. So this uptick, the sharp uptick in the prices, that has been kind of the only area of the ISMs, the PMIs, that have been in expansionary territory solidly, which is prices. So you have this inflationary component, right? Prices, whether you're looking at manufacturing or at services, prices have been firmly in expansion territory, but you have, business activity, employment, those sort of things kind of flirting with contraction, not really solidly into expansion territory. That's kind of that stagflation light sort of environment. But generally,
sorry to interrupt, but just to confirm, this increase in prices without the corresponding, let's say those green and orange lines, that would indicate that these are not being absorbed by businesses. Is that an accurate representation? And they're passing all of that on to the end consumer, or not necessarily?
Not necessarily. So the methodology for PMIs is kind of wonky, but yeah, it's not necessarily a one-for-one. You could, for example, after a normalization of the labor market, right, that we saw kind of over hiring in 2020, 2021, as that normalizes, employment's going to be weak, but inflationary kind of pressures can still be there. Also, there's been huge productivity gains too, that we've been seeing start to show up in the productivity data. So you could get a situation where, prices are, productivity gains are allowing for example, lower employment readings, but not translate into end CPI. But this is not like a percentage, right? We're looking at an index, and the way that the index subcomponent is measured is wonky. I've tried to look at it and tried to make sense of it, but it's a little too wonky even for me to make sense of how exactly it's calculated. But just from a pure kind of correlation standpoint, higher ISM services prices, which is the white line, or with manufacturing, generally that does correspond to higher inflation. Pretty one for one with about a 2-month, 3-month lag.
Gotcha. Okay, so if there is a 2 to 3 month lag, I mean, how does that feed into Bitcoin at the end of the day? I mean, is this potentially a useful indicator at all, or is this mostly backward looking?
No, ISM is definitely much more forward looking, or maybe not forward looking, but much more current than a lot of like the hard official data. It's definitely predictive and useful, very useful, I would argue. But yeah, when it comes to if we are really starting kind of this cyclical upturn in kind of the real economy, we've seen the equity market start to kind of price that in, and we've seen a broadening out. If you look at like SPY relative to RSP or QQQ relative to IWM or those sort of charts, we've seen the market has been actually kind of under the surface positioning for broadening out in a cyclical upturn for months now. I would argue that's probably good for Bitcoin. The problem becomes that for whatever reason, Bitcoin is trading 100% like a lockstep with IGV, which is the software ETF.
Yeah. I was going to get into that. We have that on the topics as well. So maybe we dive into that IGV correlation, because it is fascinating how tightly those are trading one-to-one.
Yeah. So here is Bitcoin versus the IGV. A lot of people are obviously showing this chart now. I'll take off the short volume. That's something new. But yeah, so it's extremely tightly correlated. And software has been getting hammered on AI concern, right? That AI is going to kind of eat away at software. So you've seen it trading basically tick for tick with the IGV. So if we're trading with the IGV, even though Bitcoin is the software, it's not a software company with revenue or anything. It's kind of dumb that it would be trading one for one with IGV. But if we are, if that's the correlation and that's how the algos are programmed, then it might make sense to look at IGV. And so I did that yesterday. Here's IGV. In my opinion, it looks pretty capitulatory. I mean, the daily RSI is at 15. You have that kind of like accelerating parabola to the downside, which generally marks a capitulatory event. One way to tell is the spike in volume. So we can see that over the past 2 days, the volume, I mean, we still have a couple hours here for today, but definitely yesterday, we had like 4x the normal daily volume. And again, it's corresponding to kind of a waterfall sort of price action. That generally marks the bottom. We've also seen short interest or short sale volume just absolutely skyrocket. And so again, generally is kind of thing that you see at the bottom. So kind of raises the question, like, it's not to say today is the low, right? This could go on another couple days or something, but we're probably getting close. Generally, when you see, short volume spiking, the underlying trading volume spiking 4x the average daily volume, the kind of waterfall sort of price action, generally that is the bottom or very close to the bottom. And I've been using more and more recently, I've been noticing that CNBC is pretty good contra indicator. When they were talking really poor stuff about Boeing and Intel, and I went and looked at the charts. I was like, ooh, these look like great longs. Sure enough, like those periods of time, if I'd gone long, were like the perfect entries. And the same thing is true for stuff going, moving to the downside. So they are talking a lot about the IGV trade, about software diverging from semis, and all that kind of thing. So yeah, that's kind of another soft indicator that you could add to the IGV story. That CNBC is kind of pushing it more and more. We're probably pretty close to all the smart money is already short or out, in my opinion. And so you're getting pretty close to, oh, I heard on CNBC I should go short software. Your Uber driver telling you. We're probably pretty close to a low here in IGV. And if we're close to a low in IGV, and it's so tightly correlated with Bitcoin, maybe Bitcoin gets a bounce. It's kind of a thought.
Adam, what are your thoughts? Like, I mean, from your standpoint, does it at least feel like there's a high probability that the bottom is in, regardless of price? Ignore the 65K on the screen, which it looks like Bitcoin's down another $2,000 in the last hour. But what are your spidey senses telling you in terms of where we are?
Well, I had been saying, I don't know, since literally forever, since people have been coming up with this idea that cycle theory is dead. I'm actually a pretty staunch proponent of cycle theory, the 4-year Bitcoin supply cycle. I think that actually has a pretty big impact. I did give myself plenty of room over the last few months that, to give myself an opportunity to kind of back out of that. But I definitely still said that I think that we will see a repeat of, the last, few epochs of what we saw in the charts, just specifically looking at the US dollar to Bitcoin chart in the 4-year cycles. So I think that I am definitely sliding back more into that. One area where I was wrong is I was expecting another higher high after around 125K or so. I did not feel like that was the top. But we're sitting where we are right now, it's starting to look a lot like a repeat of, historical cycles. And I don't know. I want to give it a few more days just to see where this current price action shakes out at. See if it stabilizes, see if it rebounds. But if it stays down here, I'd say for maybe if we're not above 90K in 30 to 60 days from now, I think that we're just going to have to essentially wait for the next cycle. And I know that there's a lot of non-technical aspect to that, because the cycle, the supply cycle on a technical level doesn't have much effect anymore on the marginal price of Bitcoin, but there's a psychological component to it as well, and there's just so much history and precedent there. So I don't have much of a mathematical reason for it, but I will just say, all of my instincts tell me that this is, we're in the middle of a bear market right now. Again, I will definitely correct that thesis if, like I said, if we hit 90K or above in the next 30 to 60 days, I will flip back to bull. But right now, I think we're in a bear. That's my belief.
Yeah, there is one thing I quickly wanted to share. Infra, I can see that you're going through some charts in the background. But before we get there, this is from a guy called, I'm not sure, can you see? Yeah, you should be able to see our screen. This is Zoran Cole, who I believe disappeared 3 to 6 months ago. He's got a couple 100,000 followers on X. And looking back in hindsight as to whether or not that was a top, I could not picture a more clear top indicator than a soft, pudgy penguin dancing around with Van Eck in the background as of Q2, Q3 last year when we hit 120K. So it's easier in hindsight, obviously, to tell that the bull market had top back then. And look, there's no confirmation that it is officially not a bull market anymore, but the probabilities seem to be heavily weighted both on price and on hindsight, those clear moments as to what was or wasn't the top.
Well, if we're free to expand on anecdotes, I do think it is interesting that, and I've actually said this fairly recently as well. I think that there is some evidence of a coordinated attack on Bitcoin right now, and I think that it's if you know what you're looking for, it becomes pretty convincing that there's something going on behind the scenes. So if you're looking at the timing, look at the STRC chart stretch from strategy, and look at these I guess capitulation events that have happened. The first one was around October 10th, and that was when STRC had essentially reached its par value. Okay, so the week of October 10th, which would have been I think October 6th or 7th or something like that, STRC began its official par value ATM process. And then we had October 10th happen, and that's when of course that big Bitcoin crash happened, and the subsequent crypto and stock market crashes too, but specifically Bitcoin. And then look what just happened a few weeks ago as STRC reached its stride again. We had the same thing happen, and you have the Epstein files that get released at the exact same time. You have this I don't know if you guys saw in the news, there's a kidnapping of some famous talk show host's mother, and they're asking for ransom in Bitcoin, and that's always a top talking point whenever this is hitting the news, which I find interesting. It's almost like they're going out of their way to slander Bitcoin, and I feel like there's just a lot of other things too that are just timing wise very interesting around when stretch is hitting par. So a lot of speculation there, a lot of tinfoil hat stuff, but it's definitely something that I'm watching.
I mean, it might sound tinfoil hat, but when you put a lot of these pieces together, the probabilities that it isn't not necessarily a coordinated attack, but at least some large central entities trying to manipulate the price in order to follow their own incentives, it's difficult to kind of fight back against that, right?
Yeah, it's at least interesting.
Yeah, well, look, let's leave it there. I do want to be prompt. We are going to end it at 1:30 Eastern. Guys, thank you so much for your insights. Robert, again, hopping on and just crushing it on the macro side. Super interesting stuff. Adam, great meeting you and having you on for the first time. We'll have to do this again soon. Love the steak and shake hat. If that's if that is what that is, it looks like that's stack and sats.
There we go.
Oh, there we go.
Maybe.
Beautiful, beautiful. But guys, we're going to leave it there. Thank you everyone for tuning in and watching. We will catch you next week, Thursday, for the Daily Stack Macro. Please give us a like and reshare the stream. We are hopping on for another 30 minutes with Cam from Onramp, so stay tuned.
What is up? Cam, how we doing?
Good. How are you?
Good.
Good to see you again, Jody.
Good to see everyone. Good to hear you in the comments in the chat. We obviously had a great first run. Publius Bitcoin. We had Infra, as always, on Thursdays, Startup Macro Show. And now we have Cam Stromme from Onramp Wealth. Thanks for joining.
Great to be here, Jody. It's a rough day for Bitcoiners in the market, but we'll have a lot of good things to chat about.
Yeah, and that's the thing is you especially start and just say, hey, today sucks. Like when you're red, you never want that. I think it definitely shakes people a little bit in their confidence. And hey, is this a store of value? Are all the institutions? You don't want lip service saying, guys, you're wrong. Like that number isn't bad. And yeah, I think people need perspective, but like anything, you have to talk through it and understand and educate people on how to think about things, and sometimes just live through the red days and understand, hey, like it's gonna happen, but don't pretend it's not real.
That's right. Yeah, that's why some of these discussions or podcasts or things like that are helpful to bring more nuance. Whereas on days like this, some of the typical Bitcoin memes can come across as pretty harsh or just too kind of too narrow for what individuals are going through in times like this.
Yeah. Well, yeah. So what's been good with you? What are you focused on today? What have you been talking with people about? We have some stuff we want to dive into, but first, let me be a good host and let you start it off.
I appreciate it, Jody. So as you know, I'm the head of private wealth with Onramp Bitcoin, and we are a financial services Bitcoin for business, primarily helping folks with custody, but also with trade, loans, and then a big focus for us is inheritance and helping people to think through multi-generational wealth. So as I think about some of the highlights of what I'm helping clients with right now, a lot of that is with on the dynasty trust side. So this is for long-time Bitcoin holders, high net worth, ultra high net worth folks that because of their conviction through a lot of down days like this throughout the past 10, 15 years, now they've found themselves with truly an opportunity to secure their children's future, their grandchildren's future. We've partnered with a great firm in South Dakota, First Covenant Trust and Advisors. So the trust that they're able to set up, and then our custody model, we can help clients who have a large Bitcoin holding think about how to prevent or avoid the 40% estate tax, which is a huge hit. And the last thing that a Bitcoiner would want to do is to give up 40% year after year to the federal government in taxes directly from their Bitcoin. Those trusts to shield and make the client more private, very extremely private. There's no way to crack into those and see who the holder is. So it's that, I love that aspect of it, aligning with the Bitcoin ethos of privacy and sovereignty. So that for me, it's a signal that we're doing something. We're really onto something with helping those clients in that product, but also it takes something from the traditional financial world and it has a cyberpunk ethos. It's like, kind of big government, stay out of my Bitcoin, keep it private and let me pass it down to my kids and steward it as I see fit, not just have it be, kind of taken over by tax authorities.
I think when you see, it's one of those things where it's access and education where if you pull up a tax map of where your home is, and then you start to see like it is very interesting. You're kind of Zillow snooping, to the next level, and you see who owns each of these homes, and then you start to realize like the Joneses next door, it's like the Jones family trust or the Smith family trust, and those are things that I think so much 75% of of the wealth, not the 1%, but 75% of the wealth in the world doesn't have structures like that. Not that they all need to, but they're not thinking about it properly. And as we're building a new financial system, as we're trying to, shift things in the right way, we got to talk about it. And I think inheritance is something on 21 rates, we're trying to build out more. Partner Sean's done a great job of putting more and more content out on inheritance. So, how are those convos? Because some of the early Bitcoiners, and we want to get into this, I guess, next with talking about just whales in general, but some of the Bitcoiners aren't even ready, or haven't like gone into retirement, but now they're starting to, get to the 50s and 60s and 70s to where they need to pass that down. Like, how's like starting with that process of, hey, here you have 10 Bitcoin, 20 Bitcoin, 100 Bitcoin. How do you get, this is how you're going to give it to your kid without them going ahead and having your private keys and spending it.
Yeah. So there's a lot of different kind of gradations that someone can take wherever they are. Like for our platform specifically, we can help clients with as little as 1 Bitcoin in multi-institution custody. That's like our flagship product, right? So they can onboard to that in 15 minutes and designate beneficiaries and be done. So now, even if they haven't taken care of a will or a trust, because most people just have not, because that involves the existential process of facing your own mortality and getting ahead of that. And it's something that most of us delay. So what we allow our clients to do, they can list beneficiaries. That is a binding agreement so that the Bitcoin avoids the probate process. So it's the transfer of Bitcoin from the Bitcoin holder, the client, to their wife or kids or whoever it might be. It does not go through the public record, to the public courts, and it's a smoother transfer. So right there, they can take care of a lot of what most people are looking to accomplish without having to take any extra steps. Like, that part accomplishes most of what people are trying to do with a revocable trust, where it's private and they've taken care of their will and beneficiaries. So then kind of the next level up from that would be to create a revocable trust. We don't offer those services directly, but there are plenty of places that clients can find those services, and they can onboard the trust as the account holder, similar to like your example, where clients can use a trust to buy a home, and then they have more privacy, it's in more protection. That asset is within the home. They can do the same thing with their Bitcoin. And then kind of the final step, if they have enough Bitcoin where it merits a irrevocable trust, and there are all sorts of different reasons to create one, then they can partner either with our firm or partner with, find any attorney or firm that's reputable. Wyoming and really South Dakota is number 1, and Wyoming, I'd say, is a second state for the kind of the top 2 jurisdictions for domiciling those irrevocable, aka dynasty trusts. So no matter where you are, there's some place to start and some place to improve your position, so that it does make it easier for your wife and kids to gain access to, and then gain access to your Bitcoin, but then also be in a good place from a regulatory and tax and accounting perspective once they do have those assets.
One thing I wanted to show tying into this is, let me share the screen real quick. So on Bitcoin News today, is beyond just like passing on, when you pass away, is also, you guys are your work focused on the security side, of making sure people are protecting their assets, because there's more of these $5 inch attacks, more people physically getting attacked, like podcasters potentially.
Right.
Please don't come to my house.
Yeah.
That have Bitcoin, and it's happening in multiple countries as we have more civil unrest, like we've seen in the past, year, 5 years, 10 years. Like there's more and more. I mean, I think the news shows more of it now, and that there's always been civil unrest, but we're seeing a lot more of it. People are very public. People are online. People are tweeting about, hey, I this is how I hold Bitcoin, or I'm very bullish on this, or they're posting Robinhood screenshots, which is never, recommended. Tell us a little bit about just how you approach this topic, which is a little bit different than just passing on inheritance and avoiding probate court. But how are you guys helping people on the side of protecting the Bitcoin when they get attacked or someone tries to steal it from them forcefully?
Yeah, I appreciate you asking the question, because we do educate about this topic. It takes some nuance to do, because we don't want to come across as fear mongering, but this is really an important aspect of owning Bitcoin that I think we're all familiar with to a degree, but most folks are still in a position where they don't feel like they're protected if that were to happen, where there's a home invasion, there's a kidnapping, these horrible circumstances. And this is one of the reasons that Michael and I and team are so focused and dedicated to building Onramp in this form of custody. So just a brief primer on what it is. we call it multi-institution custody. So it's 3 custodians all working together to support a client's wallet. So the idea is that a client doesn't hold any keys. They're the legal and operational owner of their wallet. They're like the quarterback. They're the only ones who can direct the custodians to say, I want to move Bitcoin out of the wallet. Also, there's 3 custodians. It's a 2 of 3 multi-sig wallet. So that means that even if Onramp or any one of the custodians went out of business, suffered a hack, etc., the client could work with the other 2 remaining custodians. So you have this really nice blend of, you're not reliant on one counterparty completely. You're also not reliant on yourself completely. And the situation that most people who have any material amount of Bitcoin find themselves in is, they've got a ledger and it sits in their gun safe, or it sits in their garage or their basement or somewhere within arm's reach, which over time becomes a scarier proposition as you have a family and you're thinking about, who am I putting at risk here besides just myself? And like, we just had a second ledger list leak this year, right? We had a Coinbase leak of customer records of who purchased the devices, where do they live, what's their phone number. So all this data is increasingly out there, and it makes for a really kind of dangerous combination. And it's why this is a nuanced conversation, because self-custody particularly is one of the biggest value propositions of Bitcoin, for sure. Incredibly valuable. But I think we need to complement Bitcoin self-custody with institutional custody, because you get the protections from physical attacks via institutional custody. You get inheritance built in, you get financial services, you get all these great things. And you can still have some amount of Bitcoin in a self-custody wallet. But if everything is in self-custody, now you are vulnerable to someone knocking down your door in the middle of the night, threatening you, your family, and this is happening more and more and more, and now potentially losing, some or all of your Bitcoin. So in our view, this is a way to protect individuals where their Bitcoin is behind multiple institutions, similar to, like Brian, I think, provides an astute analogy in this piece that, you, like Jody, I couldn't rob you for your house deed. I couldn't go into your house and find your house deed, and now I'm the owner of the house, right? Because there's records in the county. Even when there's a transaction, there are title companies, there's an escrow process, there are multiple institutions in a defined process for establishing who is the legal owner of that asset. Same applies to equities. Really, due to the fact that Bitcoin is still such a nascent asset class, we're still building out all the infrastructure that ultimately protects the investor. We don't have that yet in Bitcoin. Right now, it's all just been riding on the individual shoulders and for them to be out in the Wild West and protect from any and all threats. Yeah,
I think there's a good case to be made of perspective on that. If you think about, dynasties, you think about generational wealth and what you're trying to build, whatever your plan is, I was in college, a real estate major, and you realize that so much of this old money that's tied up in real estate, it's so hard to move. The transaction time, takes months to turn over a big, warehouse or property. And that's not something that you can easily spend, or, someone can attack, like you're mentioning, the deed to your house. It's a very involved process with lawyers, and selling, a couple acres of land is not something that happens overnight. So in the same way, people need to both understand self-custody, but they also need to understand that true wealth that's been over hundreds of years, you want to have it in a way that you're not exposing yourself either to short-sighted decisions or failing memory. Alzheimer's is something that I've seen, even in our own family can affect you. It was scary too, because a lot of times people don't have that plan written out to pass that wealth along. If it's a private key, if it's, even if it's a multi-sig and it's spread out in different vaults, is each one of those vaults, do you have a plan to give them the pass key safely? So absolutely something more people need to be talking about, but also keep some in self-custody. Always need to have the freedom money available if you get out. So question for you, and I think this is, for the audience on a day like today, whole past 3 to 6 months, we've been hearing about whales selling into strength, hits 100K, hits 126, and it's a way for whales to sell out. What's your personal take on that? Like just the short soundbite answer of do you believe that some of all these long-term holders, whales are selling? The Jody Visser comment of it's an IPO moment, early adopters are selling off into the broader public. What's your personal take? And then we'll tie that back into like some of the stuff you guys are doing.
The hardest part for me right now, and I think for a lot of folks in the market, is that there is no clear answer. Like I don't have one that I could place a huge amount of confidence behind. And typically in Bitcoin, we have had some sort of catalyst that we could point to. Even kind of post FTX, we kind of felt that firms were imploding, and BlockFi was one of the first to do it. So you could sense like, okay, there are some other exchanges or custodians here that, as they say, that the bodies will be floating to the surface sooner than later. And maybe that's still in the offing from the October 10th kind of market drawdown there, but we really don't have as clear of a catalyst right now. There certainly is a lot of data you can point to for long-term holders across multiple time periods that have been selling around this $100,000 level, and kind of my very left bell curve analysis there with like, if you go back to kind of the 2021, 2020 era, we spent about 16 months around the $10,000 level. Mm-hmm. It was a long time, like forever. You're just waking up watching $8,000, $9,000, $10,000, $11,000 back. I mean, it just did that for almost a year and a half. So for us, we're about like 14 to 15 months into that process, going around $100,000. So like if we viewed it very simply through these big psychological numbers, where you're going to have a lot of Bitcoin changing hands for all sorts of reasons, that I think is just a big natural part of it. You could have certainly efforts by institutions to manipulate this market, and by them, and just like trying to shake out the long-term retail, find better entries, because institutions are clearly here, right? You have Harvard, their largest public allocation is Bitcoin. You have Morgan Stanley, they've just filed for a Bitcoin ETF. It's only the third ETF that will be under the Morgan Stanley brands. Like, they are obviously very much supportive, and they're literally putting their name on it. You have BlackRock applying for their second ETF because their first one is the most profitable ETF that they have of all time, and it's only been live for 2 years. So that is really the signal, is that the quote unquote smart money is really in a major way starting to build out the infrastructure to come in. We have the Clarity Act coming up, or being worked on right now, and then it would expect institutions to again have a renewed focus on building out or acquiring Bitcoin products post that. So in the interim, I think there are a lot of market participants that have an interest in kind of driving out lower prices, getting better entries. But I don't have a clear reason to point to why we're in such a sell drawdown.
Yeah, it's interesting. Like, nobody has the perfect answer, and there's also interest from AI and other sectors that have been really hot. And they see continued demand and growth that would justify premiums to continue going up in those names. They see like wars happening, and Palantir able to play a big part in that. So shout out our team, Lev, who came actually on Tuesday. But Lev provided us with this great poll, and it's from this morning, and you're looking at who's most responsible for this recent price dip. Most people are saying normal 4-year cycle, which I haven't agreed with. I think it could be a wonky 4-year cycle, but we never saw the blow off top. We didn't see 150K. I don't think 126K necessarily counts as really the blow off top and upswing that you would expect. Could be wrong with that. That's a pretty fuzzy interpretation. No one has a specific on what a blow off top would look like. Or how high that is. A lot of people are still saying like quantum, Epstein, like everything that we've seen the past like 2 weeks. Is your opinion on, like, you don't have to get into each one of these, but quantum and seeing Jeffrey Epstein tied to maybe like early blockstream investments and some of the early conversation with Bitcoin, have any of these like not shook you, but made you think, like I need to like dive further and research into some of this?
So I definitely disagree with the consensus here. Like kind of like what you're saying is I don't think it's a normal 4-year cycle. Like what I've been saying is that we've been in a bear market since 2022. That really, if you look at that, we had that went at 69,000 in 2021, drew down to 15,000, and then we really recovered slowly back up out of that. And you really had the ETF bid, you had Trump elected, but kind of like a slow, orderly march up, and it did coincide. The top did coincide kind of in the time frame of a 4-year cycle. But you're right, like the 4-year cycle, to me, what that means is the halving is the catalyst, and that creates this supply shock, which then leads to a parabolic run, and then we have a large 70 to 80% drawdown post that. But we didn't get any of that. So absent the parabolic run, that means that signals to me that either the halvings are no longer relevant, or maybe that we need to even reconsider when the last time halvings were relevant. Maybe Bitcoin was more driven by the business cycle and liquidity more than it ever was about the halving. I think it's a little bit of both. Like in earlier days, hard for me to see how the halving wouldn't have been a catalyst, but then you do look at some of the patterns of global liquidity, and it really matches up with the halvings really well. So you think about that makes sense given Bitcoin's scarcity.
To support your point, let's pull up Bitcoin versus gold. I think now it's like you see this, and how this is 2020 is like it starts at 2018 here.
Yeah.
And Bitcoin versus gold, you just didn't really have, I think, that full movement. Like you're barely over the top, I think, of our past moves up. Is the other obviously largest store of value that we have, outside of say like something like real estate. So this is, to me, shows there wasn't a euphoria that Bitcoin has, supplanted gold as the biggest, store of value, as the future, and that it was out of line of previous tops. It's barely, I think, over 21, the 2021 top or 2022 top on the specific Bitcoin to gold chart. So it's definitely always a good thing to watch, because it's not affected by inflation nearly as much, or money printing, this chart versus say Bitcoin over the US dollar. So for me personally, I agree. I think this is, no one knows, which is not a good answer to give people on the stream today, but no one knows. But if you're also confused, you're not alone.
That chart is kind of brutal. I was looking at that last night because Bitcoin priced in gold, we're actually below the 2017 all-time high. So basically, like when you look at that chart, if you zoom out even a little farther, we had a big run up in 2017 and then kind of just been chopping sideways more or less since then. So if I'm trying to, this could be copium, or really just trying to, again, understand what the dynamics
Not
are.
wrong.
Yeah, it's pretty brutal. I think we're just so much earlier still than we take for granted sometimes, that for us, it's a risk off asset. And then particularly if you have your custody dialed in, you're not concerned and you can ride through the volatility, but that quickly sentiment can change. And then you find out how few people have spent the time to learn and educate themselves about it, to build that deep conviction that's required to go through the volatility. So the things I always anchor to it, nothing about the fundamentals has changed, right? There's still 21 million blocks are still coming out every 10 minutes. The network has never been stronger from a hash rate perspective. So all those types of, true fundamentals that you want to look to are rock solid. And now it's just about having that being reflected in the price over the long term, but having to suffer through it in the shorter term. Okay, so the next topic, Jody, if I can transition that one, the quantum and Epstein. Okay, man, the Epstein thing, what a gut punch that Bitcoin, of all the ugly narratives we've had through the years, starting from drug money, going through FTX, and now like we have pedo coin as one of the latest slanders. That's a rough one. Again, for you and I, it's pretty easy to dig in and see that, no, he's not Satoshi. There's nowhere even close to having some major impact on what Bitcoin is or represents, and it's open source code, and we can review that. but these are the headlines, or these are other reasons for people to, maybe dismiss Bitcoin or delay their understanding of it. And we do have folks in our circles or clients that are bringing up these things as factors, and in quantum too. Like you can tell it's a bear market because every bear market, quantum concerns come up, and it's FUD that's been around for a long time, but Bitcoin seems like it has a particular like marriage to quantum FUD, as if Bitcoin would be the only thing in the world affected by quantum, like the nuclear codes or Wall Street financial systems built on COBOL would be unaffected, and Bitcoin is uniquely affected. It's for some reason those two pieces sit together. So we don't necessarily need to go down all those aspects, but it's definitely having an adverse effect, even with longer term holders, and having, causing some moments of reflection about how prevalent that threat is or not.
Yeah, I think there's a good case to be made of it is good to spurn people to action. You do need to address, these things where we need to have more, I think, clear direction on, say, like Bitcoin Core, of where we're moving to, even if we would agree there's so many other things that are going to be affected by that. But I think, just like so much of earnings reports is around how the CEO is speaking, how they set forward guidance, what the direction they set of the company. I think this is where Bitcoin not having a leader, it is a weaker point. Not saying that you would change that at all. Like, I think it's great. This is decentralized money, but people are looking for that guidance. People are looking for, that faith of, is this being addressed? And then obviously, like with the core versus not, it's like coming out of that. I think there's like a little bit of, fractured support on which camp, or, maybe distrust on where the direction technically is going, or, Bitcoin as software, Bitcoin as, a technical product. So I think that's where having a plan and having people get together and get behind, certain plans to like address that, I think is big. But we also don't want to rush into anything. As Michael Saylor says, the biggest threat to Bitcoin is an overactive developer that rushes out some solution that is not in the best long-term interest, or not decentralized, or, invalidates privacy, or any of these concerns.
Yeah, I agree with that approach. That's a nice nuanced middle ground between, could quantum be a viable quantum computer at some point be created and established? Possibly. The tough part is there's so few people with that level of technical knowledge to ascertain, what that threat is like and how fast it's developing. Right now, a quantum computer can factor the number 15, up to 15, and that's it. So it's very limited now, but the unknown is what that exponential progress could look like. So we do want to have some serious dialogue with people who are competent to delve into and understand what our options could be, at the same time without, like you said, fear mongering and kind of encouraging people to take steps as that would be proposed as preventative measures. But we know that nothing comes without trade-offs. So carefully analyzing, well, what would be the trade-off of moving to this new address type, or forcing this new, or proposing this new soft fork or hard fork.
Yeah. So we'll see. That's a topic for another day. One thing have to bring up. So you guys, we saw last year, started a partnership with Arch to do Bitcoin-backed loans.
Yes.
And so that's something you've been talking about. Obviously, Arch, you'll see at the bottom of the screen, is a sponsor. So full disclosure on the Daily Stack, they are our trusted partners for Bitcoin-backed loans. But I think it's good to have other perspectives. You as a partner, you're from the wealth management side, probably talking to bigger fish than me or others, that come on the show. Like, what's been the reception like? How is like the partnership with Arch been in regards to like talking with these, people that they're already thinking about multi-institutional custody if they're working with you? Are they doing the buy, borrow, die? Are they following that process to like get liquidity but keeping upside exposure?
Yeah, I'm glad you brought this up. Arch has been a fantastic partner. It's really a very easy to use, elegant product that they've built. Their team is responsive. very easy to work with. And when so when we first formed the partnership, we're looking at the landscape of lenders, and we already knew what we were looking for because Michael Tanguma, Onramp CEO, and I were previously with Unchained Capital, which was one of the only lenders that survived the 2022 FTX collapse, that whole debacle where Celsius, BlockFi, Voyager, Nexo, so many other lenders went out of business. Unchained Capital at the time was, and still today, one of the only lenders that was not rehypothecating collateral, had a focus on custody, conservative LTV rates. We stewarded our clients through that period. And so when Michael and I left, we're building Onramp, we knew exactly what you need, in our view, to run a successful Bitcoin-backed lending product. And Arch had built it. They had built it starting in 2022. So they've been through multiple years and upturns and downturns now. So they never rehypothecate collateral, similar principles of conservative loan to value ratio. I love the way that they're handling margin calls. That's something we can chat a little bit about too, because I'm helping clients through that process right now and have done well.
Yeah, we're at
it's like one of the
63 or 65
of these drawdowns. I really feel for folks who are have taken on loans, and hopefully they prepared for these types of events. But when you have this is really when your lending partner either shines or you realize you picked the wrong one, because Arch is really shining right now. Like clients have segregated vaults for their collateral so they can view them. They can assure themselves at all times that their Bitcoin is not being rehypothecated. And then they know too that if they need to respond to a margin call, they have more clarity on where that Bitcoin is going. It's not going into kind of a black hole like unfortunately folks were doing with BlockFi and wondering, am I throwing good money after bad? They're knowing, okay, I'm truly in a secure way improving the health of my loan right now by restoring that loan to value ratio.
Yeah, and some people want to be walked through it. I think it's I have a big Bitcoin backed loan out, and it's at times like these where the price is actually 66,000 now, but I don't, I don't, at the top of my head, I don't wake up and think about okay, what is my margin level right now? Or what point is this going to get liquidated? It's not something I think about because it's a long-term, play, or maybe it's a year-long loan term. I have a lot of other things to worry about, in the time being. So I think combining that service of having someone that's, like you guys, advising them on multi-institution custody, looking at long-term wealth and inheritance, but then as part of that, you're going to want some liquidity, you're likely going to want liquidity, and looking outside of Bitcoin, obviously for our traditional finance audience, logging in, it's just so common. You see people with these massive stock positions the more you dive in, and they're not always talking about them because they don't want to be, either look like a rich jerk on TV, or either they don't want the security risk of just telling everyone about their finances. But let's say you're a whale that has a $50 million position in Tesla. So many people are borrowing against that equity position to go fund their lifestyle, to go potentially make investments in, a startup or things that are risky. And not saying that risk is always okay and that you shouldn't avoid that, but it's happening. And that's how the wealthy, operate. And that is not something that's taught in school. And it takes you a long time to really expose yourself to it, unless you grow up with a silver spoon in your mouth and, you're being fed a trust fund. If you're not fed a trust fund, how would you even know that that's a normal thing to do? I think that's the thing that people realize is, even for women, they say in the workplace, it's they don't take risks. Men take a lot of risks. And that's why they move faster. But I think also people that start on the lower end of the income tier, they start, without a lot of privilege, they don't take a lot of risks because, in some regards, but let's say you're doing everything right, you work hard, put your money in an index fund. Sometimes it's hard to get to that next level unless you take some calculated risks. And that's what people that are already wealthy are doing. If they're oh, I'm going to have this huge position in Tesla, but I'm also having these startup investments, and those are the ones that outperform 10x, and Google had a 10x return, or is going to have a 10x return on Anthropic. Nobody else had access to Anthropic, but Google was one of the first large investors in there. So I think it's really good for people to start to understand of like normalize of what is the financial, like with the financialization of Bitcoin, if it is a store of value, there's already so much happening with real estate and other stores of value. It's going to come to Bitcoin. Be ready for it. And if it doesn't come to Bitcoin, then we have bigger problems that it's not being seen as that big of an asset class.
Yeah, 100%. It's it can be such an effective tool for people rather than sell their Bitcoin, pay capital gains, lose out in the future appreciation of the asset to go either, buying more Bitcoin, buying real estate, expanding their business, or buying a business. Those are the top 3 use cases that I've seen over the years. Mm-hmm. So if done correctly, then you can, avoid the taxable event using your Bitcoin as collateral. You're drawing down liquidity, and then you are able to accomplish your goals, live your life, and then you still get the benefit of that Bitcoin price compounding year over year and not losing out on that. So I have multiple clients that have been living off of Bitcoin Standard by using a combination of our long-term multi-institution custody vaults and then using loans and rolling those loans over. The rates become more competitive every year. When we started the partnership with Arch a couple of years ago, the rates were in like the 12 to 14% range. Now they're down. For larger amounts, they're down sub 10%. So I'd say about the 10 to 11% range.
8.49.
Yeah. Good call out at the highest levels there. So, as the Fed funds rate comes down, that certainly helps, and the team is able to bring down rates in a commensurate fashion. But then it's also a product of the market better understanding Bitcoin and collateral and how these products are safely managed and stewarded. And there's still some overhang, I would say, from that 2022 FTX blow up. Like when they're thinking about lending dollars to a Bitcoin backed lender, they really need to understand the mechanics of how margin calls are handled and what does the custody look like and who is the kind of client profile. But all that is improving across the board. So as such, you see the rates improving.
Yeah. People are excited about it. I know Jack Mallers spent some time last year at the Vegas conference talking about sub 10% rates. Great to see it, and not just from like one provider or not
right.
A concerning, DeFi protocol or L2 on Bitcoin that's doing the lending, but actually, have someone that is able to offer that in like reputable institutions. I believe Anchorage is who they use. So, we have Arch on here showing 8.5%. So that's going to definitely spur a lot of other lenders to get really competitive rates, try to get down there, which is good for consumers, good for listeners here. Like rates are getting better. You're going to be able to park more money in Bitcoin, long-term store value, but still have some liquidity. I built this page. So if there's anything wrong with it, please hit me up. Let me know. Hey, Jody, you need to put some work in here. One thing we have for you guys, inheritance. So we're building out more of our stuff on inheritance, but we got Onramp and our friend Cam here listed here. And this is where we want to definitely invest, or we are going to invest more in some education and content here. I think there's some really good creators out there I'd love to bring in to also like have their own voices, because it's less about having just the right information. I think AI proves that you can find information easier these days, like by far, and it's very tailored. But I think having different voices is what we're learning. Like find something that resonates with people, because it's going to look different every single time, and it's not going to be me that like is the best educator for something like inheritance. And if I see that in your job, you need just different people from different walks of life to show people why they should care. To show the Texas oil guy why he should, move his investments more into Bitcoin, not be fluctuated by oil price if we hit peak oil soon. And then here's how you need to handle it, so generations after you have access to that.
Mm-hmm.
So Cam, so we're wrapping up the show. What can you leave us with? What are you thinking about? On this day, are you taking a break from the screen and unplugging, touching grass, or what's our audience be doing?
No, if you're struggling to find some conviction, just going back to the fundamentals for me is always so helpful. Just so we used to work with Parker Lewis, his Gradually Then Suddenly series. It's all fundamentals, right? Like all broken down into different topics about just re-anchoring to there's only 21 million, or what Bitcoin, what's its fundamental value proposition? Has anything changed about the problem that we face and the solution that Bitcoin offers in terms of ever increasing debt, a dollar and fiat currencies that are increasingly being debased versus a finite store of value? So none of these core attributes of the problem or the solution have changed. They've only improved for Bitcoin, and they've only gotten worse for on the problem side. So I think it's helpful too, just to kind of anchor back to that. Another great piece, so Brian Kubelis, our chief strategy officer, he just we can link to this too, or I can tweet it out, but he had a piece in December, it's on our website under the research tab, about how in the short term markets are a voting machine, in the long term they're a weighing machine, right? So this is Warren Buffett quoting Benjamin Graham, quoting Brian Kubelis, but just saying, like markets in the short term, they can be irrational, they can be wildly dislocated from what we would perceive to be their current value, but in the long run, those fluctuations get taken care of, and Bitcoin shines through. So if you've been through this long enough, you have been through some other painful drawdowns and some euphoric runs, and I can tell you too, of course, because we focus on custody, because if Bitcoin is your long-term store of value asset, then the more comfort you can have around custody, the more easily you can ride the volatility as well. If you don't have to worry about custody, that's one more thing you can take off the table and provide peace of mind. So I'm trying not to just speak my own book, but we focus on it because it is so core to everybody who either has a large position in Bitcoin or is working to build a position in Bitcoin that's meaningful to them. The stakes only become higher from the custody and inheritance side as you do that. So the more you can figure out a way either to partner with us or partner with a great, find or create your own great Bitcoin solution, that will provide folks with a lot of peace of mind. So I'm always bullish. I ultimately still bullish. I bet we'll end the year green, and we'll have, I think the Clarity Act will get passed. Institutions will continue to kind of, poke up their head out of the woodwork and say that we're not scared of Bitcoin anymore. We're going to support it and build Bitcoin products around it, and we'll steadily advance forward. So ultimately, not concerned.
Yeah, I think it's to make smart plays for the audience, everyone listening. Just don't do short-term dated options. Be conservative. This is the day that proves, okay, that's why you stack for the long term. That you look for dips like this. You look to have capital available to buy the dip, and then allocate in a very smart way. DCA in. This is exactly the kind of day where real wealth is made, because buying at 66 is strategic if the local high was 126. So you could make a pretty good return there. Cam, really appreciate you coming on. We'll have to have you back on, and let's hope for greener pastures ahead.
Thanks for having me, Jody. Take care.
We'll see you.